Listen up. Silver right now is stuck in a tricky spot. It's about 30% above its recent low, but also 30% below its recent high. It's like being caught in the middle with two different realities pulling in opposite directions. Hello, everyone. Welcome to John AG Expert. My name is John, and I have over 10 years of hands-on experience in the silver and gold markets. On this channel, you'll get honest market analysis, clear price action insights, and practical trading and investment guidance. No hype, no false promises. If you're serious about silver and gold, you're in the right place. Don't forget to subscribe. And now, let's get back to the market update. While the price bounce and forth in this range, something has shifted under the surface. Something most people won't notice until it's too late. Here's where silver is today. The Western spot price is $82, futures $82, Shanghai spot $88, and Shanghai futures $90. That $6 premium between East and West isn't going anywhere. Why? Because buyers in the East are willing to pay more for physical silver while Western markets still set the paper price. That gap usually doesn't close quietly. What happened behind the scenes is serious. COMEX registered silver just dropped below 100 million ounces, the first time this has happened in modern records. In one day, almost 5 million ounces left the system, leaving just 98 million ounces. Meanwhile, March contracts show roughly 65,000 open positions, that's about 325 million ounces, of paper claims against only 98 million ounces of actual silver. The ratio just hit 3.3 to 1. The first notice day for March delivery is February 27th, just 2 weeks away. This is a key moment for traders, especially those playing paper silver. On the technical side, we were watching the 150-hour moving average for potential support, but silver just fell below it again, meaning it's acting as resistance, not support. That means on paper, silver could slide further. I want to be clear, this isn't a buy signal, it's not financial advice. This is about learning to read the market, seeing where pressure points are, and understanding the risk. Your priority as an investor or trader should always be protecting your capital first. Those who survive the swings are the ones ready when the real move finally hits. Here's the bigger picture. Silver rallied from about $63.90 to $93, then corrected down to around $80. That's about 30% up, 30% down. A perfect example of equilibrium. Bulls got some validation, bears got some too. But the story isn't just about charts. It's about real-world demand and supply. Let's talk supply and demand because this is where things get interesting. The Silver Institute just released its report, and it's not good news for anyone waiting for a price drop. For the 6th year in a row, silver demand is outpacing supply. This year's forecasted deficit is 67 million ounces. Investment demand jumped 20% to 227 million ounces, the highest in 3 years. India alone is expected to import about 220 million ounces, just one country. That's roughly 25% of the world's annual mined silver. Industrial demand is around 650 million ounces, slightly down thanks to some efficiency in solar production. Mine production rose a tiny 1% to 820 million ounces, and recycling went up 7%, topping 200 million ounces for the first time since 2012. Even with all that, demand still outpaces supply by 67 million ounces. That's a serious drain on available silver. People who pay attention to the Silver Institute reports see the long-term setup clearly. Those waiting for mainstream news, they'll be chasing the move after it's already happened. Now, let's zoom out to the bigger picture. Geopolitics. China is cutting back on U.S. treasuries, stocks, and bonds. Their holdings dropped to $1.56 trillion, one of the lowest in 14 years. Official Treasury holdings fell by $6.1 billion in November, now at $682.6 billion. On top of that, Chinese banks are being told to start selling U.S. Treasuries. Why does this matter for silver? Because when the largest foreign holder of U.S. debt reduces exposure to dollars, that money goes somewhere else. Commodities, physical assets, infrastructure, and strategic materials. The World Uncertainty Index is at levels higher than the 2008 financial crisis and even higher than the pandemic highs of 2020. Simply put, we are in extremely uncertain economic times. Jesse Livermore, one of the greatest traders ever, said big profits come from big swings, not day-to-day market chop. The silver market's multi-year deficit, combined with global shifts away from dollar assets, is that big swing setup. But most people will miss it because they wait for confirmation. By the time it shows up, the move is already over. Timing is everything here. The Shanghai Metals Exchange will be closed from Sunday, February 15th through Monday, February 23rd, for Chinese New Year. That's 8 days where the Eastern physical silver market basically goes dark. Western banks know this, and history shows what usually happens. During this closure, paper markets get heavy pressure applied. Prices can be pushed down temporarily because the big Eastern buyers aren't around to absorb it. But here's what's different this time. China's silver market is already in record backwardation. That means the front-month contract is trading at a record premium over the next active month. Extreme backwardation like this signals a real inventory shortage. Why is that happening? Investment bar demand and solar manufacturing are draining silver stockpiles faster than they can be replaced. Short sellers are actually paying fees just to delay delivery. That's not normal. That's a true physical shortage. At the same time, U.S. macro data shows a disconnect. Job openings are falling, unemployment is likely to rise, and corporate bankruptcies are at levels not seen since COVID. Consumer debt defaults just hit 4.8%, the highest in 8 years. The economy is weakening, yet silver is up 150% in the past year. Gold is up 76%. This isn't a recovery. It's a currency problem meeting supply constraints. Real-world economic problems exist, but metals are rising because cash is losing value. Ray Dalio explains in Principles for Navigating Big Debt Crises that debt cycles don't end with sudden crashes. They end with currency devaluation. That reduces debt burdens but destroys purchasing power. Right now, we're watching that playbook unfold in real time. On top of this, there's a new development at the state level. Texas just announced it will start producing its own gold and silver coins for IRAs and 401k accounts. The initial run is commemorative, but bigger batches are planned for widespread retirement account use. Why does this matter? If other states follow, Florida, Wyoming, Montana, tens of millions of retirement accounts will have direct access to physical metals. That creates a structural permanent bid for gold and silver from retirement savings. Let's get into the COMEX numbers, because this is where the system shows real stress. Nearly 5 million ounces of silver left COMEX in a single day. Of that, 2.5 million ounces came from J.P. Morgan and 1 million from Loomis. Overall, registered silver fell to 98 million ounces, below 100 million for the first time in modern history. Meanwhile, March contracts show 65,000 open positions, which equals 325 million ounces of paper claims against just 98 million ounces of registered physical silver. That's a 3.3 to 1 ratio. Far more paper promises than actual silver available. If February deliveries are any guide, the March contracts are heading for a huge physical delivery test. February deliveries already exceeded 100% of open interest, which is unusual. Here's how paper markets manipulate things. Some contracts can roll to May or be cash settled to avoid actual delivery. Banks have tools to manage deliveries, which is why the system often looks calm on the surface, but underneath, physical silver is moving out of vaults, shortages are real, and the paper market is stretched. Technical traders should watch the 150 EMA closely. It just broke, which means resistance is now in place. Silver could retest lower before delivery pressures show up. But fundamentals tell another story. India importing 25% of global supply, 6 straight years of deficits. China paying premiums to avoid delivery. All documented facts. The key dates to watch. February 15th, 23, Shanghai closure. 8 days of potential manipulation. February 27th, first notice day for March contracts. What to watch for? Will March contracts roll to May or stand for physical delivery? Will the 150 EMA be reclaimed or continue to resist? How will Shanghai premiums behave when the market reopens? Every one of these signals matters. This isn't hype. It's structural pressure building across multiple fronts: technical, fundamental, geopolitical, and timing. Paper markets can pretend business is normal, but the underlying reality is tightening. Remember, your capital is your responsibility. Verify the data yourself. Study Silver Institute reports, COMEX statistics, and Shanghai futures updates. Look at delivery ratios, premiums, and deficits. Understand what these numbers mean before acting. Silver is at a critical moment. The setup is clear for those who do their homework. The rest will be reacting after the move has already happened.